We will go back to bull market. It will happen. But if we have a demand destroying event where there is a massive chase into or demand for liquidity, a lot of good things can be sold because there's always buyers for good things where there isn't buyers for bad things. This kind of is a much better structure for the upside, and I'm biasing to the likely probability that this will indeed be an upside break. And an upside break is bad for precious metals. You have a target. That doesn't mean it has to make the target, but you have a pausing, slowing area on our second interim, which typically is respected, the second interims at 72.5 and then 80.5. That's likely to see gold and silver sell off, silver more so.
The gold and silver markets are at a high stakes crossroads as of May 7th, 2026. While both metals have recently hit significant highs, with gold testing resistance near 4,738 and silver climbing towards $79, a sudden shift in the macro landscape is creating massive volatility. Hopes of a peace deal in the Middle East have sent oil prices tumbling, which paradoxically is strengthening the US dollar and cooling the immediate inflation hedge demand for bullion. With the market currently facing two-way volatility and testing critical support levels between 4,400 and 4,440, the window to react to this structural shift is closing fast. Joining us to break down these movements is Francishunt, widely known as the market sniper. In this video, he warns that while a long-term bull market remains the ultimate destination, we are currently facing a demand-destroying event where a desperate chase for liquidity could lead to a sharp sell-off in even the best assets. Hunt highlights specific technical targets at 72.5 and 80.5 that could signal a major upside break for the dollar, an event he believes would be particularly punishing for silver and gold in the interim. Now, we present the clips from his interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
So let's just cover the gold and the silver standalone before I take you to the concern around that. We did indeed have sell-offs after an incredible run-up, by the way, it's worth pointing out. And those that mocked us for saying there will be a third wave of selling have gone a little quiet. There you go. That was your first, a slap in the face. That was your biggest. There was a lot of buy the damn dippers that had been trained all the way along the bull market to buy along the bottom, buy along the bottom, buy along the bottom. You then squeezed with an even tighter low vol moment and broke, zip, zap, deeper sell. The percentage was larger on the overall move, although it was more staggered and slightly less violent. This was pretty capitulative here. This had the most violence and volatility in it, the first move. And now you've had the least violent of the third sell so far. And you're actually up on the day, even though you're trading off generally over the larger week since that high. So the third sell call has occurred on gold. Whether people want to credit us with that or not, it's up to them. We don't care. It's about making money, not being verbally right on calls you've made publicly on YouTubes. We get plenty things wrong. We want to make money. We take our losses quickly and we let our winners run. So on the weekly side, silver also has sold off. You'll see it 1, 2, 3 red candles. So as we warned, a sell-off did indeed ensue. But then, okay, should we not be looking for a bottom soon? Here's the one thing that stops me from saying yes, 100% unequivocally to that. We will go back to bull market. It will happen. But if we have a demand destroying event where there is a massive chase into or demand for liquidity, a lot of good things can be sold because there's always buyers for good things where there isn't buyers for bad things in liquidity shakeouts. So people tend to sell their best, sadly, because it's the easiest to raise funds for. And there is a deep-pocketed buyer for gold and silver, that I can assure you. So let's just talk about gold and silver. In fact, I'm going to do something even more than use the gold-silver ratio. I am going to reconstruct the gold and silver ratio by actually getting the gold chart and dividing it by the silver. So if we don't have the major event that we fear is coming, or until we do have it, we can reflate a little bit back up on gold and silver, and you might be seeing a little bit of it now. But the concern we have on a more larger scale is that there is something afoot. So we'll just put the HVF draw tool on sleep. There we want to see all our draws, and we want to highlight this blue line. Now, we gave a little bit of a peek into this on the show with Danny recently, Capital Cosm. Well done to him for getting through 100,000 as well. Does some good work consistently. And this was the big key level of 65. 65 is an important number for the gold silver ratio. Let's go 2 weeks and just get a bit more of the info on. You can see it even if I draw it through here. There was a squeeze even here at the same 65 range that you battled and then you spilled from. But here, let's start from here though. You run it, but key resistance, you sell off. You run it, but key resistance, and you sell off. You run it, and then a small pennant, squeezy, squeezy, Japanesey, and up you blow. You're now above the 65 level, but you bang yourself out, marginally higher highs, and eventually you have a smash down, 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 down. You run it, but you are generally supported, and you make a grinding move away. You have a super blow off. You get absolutely spanked. You get a rally. You get spanked again. You run it again, and you buy up. You come back down and you just run it again and you get bored up. Then we get into the holding box that we sat in for quite some time in the rough area of 76 to the 92. You had to pop out the top where we queried, could it go higher? And then when it broke the bottom, we said bull run engage. The 75 level. You'll remember saying break 76, 75 range. You are in a bull market. You traded all the way down to 43. That is the significance of the blue line at 65. So if I bring you back to this right now on a lower time frame, here's the challenge or the problem that you have. And that is you are sitting on an upside potential break that wishes to take the 65 and is projecting somewhere between the 79s to the odd 82 range in terms of potential upside. So let's put that on. Let's actually take, we want to delete that draw tool. We put the point and figure on. And we have a concern that this will lead to an upside move. And on our point and figure, I think it was the weekly time frame. Let's just see. We had an 82.78. So you can have a look at that. 82.78 and a 73.8. Two projections from the move, the thrust off the low there and the thrust off the low there. Now let's do our HVF method draw. So we'll say goodbye to the point and figure charting. And you will see the HVF draw. I'm going to drop a time frame for that one. And we are going to say, let's say all the impulses are 100% in. And that is your relative low. And you will find for yourself that you're looking at an 80.5 upside move if this is an upside break. We can be wrong as ever and always. If you run that 58.9, you are going down instead. So this is going to be 180 degrees entirely wrong, kind of like how we were with oil when we thought you could sell off. And that can in fact be the case. But the structure of this HVF, so the HVF structure, it's less, our oil call was very high risk. We knew it. It was an ascending first in a new trend. It's very high risk to get that one wrong. There was a high chance we would, and we mentioned it in the video. This kind of is a much better structure for the upside, and I'm biasing to the likely probability that this will indeed be an upside break. And an upside break is bad for precious metals. You have a target. That doesn't mean it has to make the target, but you have a pausing, slowing area on our second interim, which typically is respected, the second interims at 72.5 and then 80.5. That's likely to see gold and silver sell off, silver more so, cash COMEX price, good luck with the premiums. So if you're thinking of a lump sum, you may get a cheaper price, but the premiums will be higher, but you still should get a saving potentially if that turns out to be true, pointing to a demand destroying event, which then has me looking at the Dow Jones and the Dow Jones Transport and saying, but I feel toppy on them, and I think the leading indicator is already 21% down, etc., etc. Hence making the case for something we've already said: sell in May and go away, new Fed chair, seasonalities. Hey, we're just trying to save you from some pain, and we're trying to give you ideas, and there's real opportunities. Markets make a lot of money when they fall to the downside. Shorts could serve you very well if you know what you're doing, if you have inverted HVFs, and you understand the value of stop losses, targets, and overperformance, and how to manage for that, so that you actually take money off the table when you are winning at key selective moments.
The gold and silver markets are at a critical juncture as the buy the dip mentality faces its toughest test yet. After an incredible run-up, we are witnessing a third wave of selling that is challenging long-term bulls and creating massive two-way volatility. A potential demand-destroying event is looming, where a desperate chase for liquidity could force investors to sell off their best assets, including precious metals, simply because they are the easiest to liquidate. With technical structures pointing toward an upside break in the gold-silver ratio, a significant interim sell-off may be imminent, offering a high-stakes window for those prepared to navigate a sell-in-May scenario. FrancisHunt breaks down why he is biasing toward a likely upside break in the gold-silver ratio, targeting levels of 72.5 and 80.5 that could signal further pain for bullion in the short term. Hunt explains his disciplined sniper approach to trading, emphasizing the importance of taking losses quickly and letting winners run during these capitulative market moves. He provides a roadmap for identifying liquidity shakeouts and explains how traders can actually profit from the downside by understanding technical structures and managing risk at key selective moments. Let's get back to the interview.
What about this divided by gold ounces, XAU-USD, divided by gold ounces, bosh. And here we go. I'm going to just also take even the point and figure off now, just to have a completely clean chart. We'll wipe our face and we'll go back up to the monthly time frame. So we continue to tell people that you are already in a correction. Many of you will remember that we've done this macro, this far larger draw. I think it's on 12 months. We've shown this particular chart many times. Which shows all of these many times, I would say, almost too many times, because we don't want you to forget. But this is the Dow Jones in gold ounces. I will highlight it one more time. That was the Federal Reserve era, traded pretty steadily between 2.5 and around 5 gold ounces. 2.5 gold ounces to 5 gold ounces got you one basket of the Dow Jones. Then you spiked during the roaring 20s to 18.63. Into the Great Depression, you collapsed below 1.88. Then you went into a reflation era from 1929 all the way up into the 66, the beginning of the Vietnam War starting to heat up. And then you went as high as 28.47, 28.5 gold ounces. To get you one basket of the Dow Jones. Incredibly overvalued Dow Jones. Vietnam War, military industrial complex, lots of waste, lots of debasement of the dollar, boom, all the way down through below 1. Less than 1 gold ounce to get you the full basket of Dow Jones. Peak Gold and Volcker, that was the 80s, 1966 to 1998. You only took out the previous high in 98. Boom, just as you were blowing off into the .com, 99, and then done. You went marginally higher, 44.93, only got past 28.47 from 66. That's a lot of years, a lot of decades of your life. 32 years. There was also 30 years here, by the way. We're doing the time frames inside of this so that you can also try speculate on when this does. The other key element that we made out of this whole work and job is the following. We noted that the bigger you go, this is a broadening structure, back to our transgender pink. This is a broadening structure here. It's a bigger journey to the high side and to the downside. And as it got bigger, you had these halfway mark rallies and then your final low. On this one, even further at 45 gold ounces, Here is your halfway mark rally, and then you've got to go down, and we think you go below 0.99 this time, and we're guessing there at 2/3 of a gold ounce. And you had that rally. You might think that rally is a bit high up. Don't forget, we are in log scale. This is already down at that low, not much above 5.5, going on 6, when you were at 44.93. 45 ounces. So actually that's not the middle as it looks. It's quite low. Even going through here is not the middle, somewhere between that 22.45 rally high that you got there. Even 22.45 is half 45. You are already halfway down from the high when you're at that level. That's what log scale does. So just to help you visualize that, you should always look at a log scale, but let me delog it for a second so that you can see. That is halfway corrected down, okay? That is halfway corrected down. You've got more to go. You're at 10.7. We're saying sub 1. That is why we are saying that gold still is the winner, the macro the winner, and that stocks will rebase. So let's go back and understand now on a shorter time frame where we are, because I wanted to give you the big context. This is all corrective in gold ounces. Dollar. How do I say dollar? Stamp that out. Gold ounces. So I'll go back into log scale because we're on the monthly, but you understand now what scaling does as a reminder. And this is to help you understand the markets better, friends. We want you to win and not get devastated. This is a potential warning call that you might get a major crash. Here you have, for example, you could structure this as a massive first impulse midway through by time. You have perfect symmetry here midway through, and another box, boom, boom, bosh, and you're bouncing, and you broke. You broke, and you failed to make a new high, but it is still in the double top category, 22.45. This is a bit lower, it's about 21. There's your 20 number, and you're somewhere halfway in between. And over, you try to hold that level at 16.5 for a while. You dipped, you rallied, spiller, absolute thriller, all the way from Manila. Yes, you knew I was going to say that. Bounce there, small shoulder, much like you got the small shoulder here. There's a tendency to symmetry in patterns. Look at this half-time event as well. There you go. So this was 2020, the beginning of 2020. This is 26, that's 6 years. Where was 2020 through to 2014? 6 years, 6 and 6. Oh my goodness, too many of these numbers. Hey, I don't make this up. That's what I'm seeing. I'm just telling you. You've recently seen 2 candles go up. 2 candles go up against the bear call that we are making, that is saying you will go lower. That has been gold selling off while the stock market remained relatively strong. But what about, I have a look at the Dow Jones Transport and have a look at this. You see, I don't think gold goes down that very much in a time of debate, but stocks could go a whole bunch more.
The gold and silver markets have entered a volatile repricing phase. While both metals recently surged, gold testing $4,738 and silver hitting $79, a sudden macro shift has upended traditional logic. Counterintuitively, reports of a potential US-Iran peace deal have sent oil prices tumbling, which is cooling inflation hedge demand and causing metals to trade more like risk assets rather than safe havens. With the market now facing a demand-destroying event where investors may liquidate their best assets to cover other losses, the current two-way volatility is testing critical support levels. This is a high-stakes moment where the standard buy-the-dip strategy could face its most brutal challenge yet as the market hunts for immediate liquidity. Share your thoughts in the comments section below. If you found this market analysis valuable, please support the channel by liking this video and subscribing for more exclusive Precious Metals content. Don't forget to hit the notification bell to stay updated. Thanks for watching.